All right, so it's 12 o'clock, so I think we can go ahead and get started. I wanted to welcome everyone and thank you for joining us for this webinar today on tax planning considerations for 2024. My name is Ashley Webb, and I'm the marketing manager here at Mercadien, and I'm pleased to introduce our presenters for today, Holly Sabo and Eric Whalen, who are both managing directors in our tax practice. Holly specializes in individual tax planning, where she works closely with individuals providing expert financial, tax, and estate planning strategies customized to their needs. Additionally, Holly has in-depth experience with fiduciary income tax planning, federal and state tax compliance matters, and estate and gift transfer tax planning. Eric specializes in business tax planning, where he works closely with CFOs and business owners and assists them with multi-state corporate and individual income tax planning, as well as budgeting and forecasting to help improve and grow their businesses. If you have any questions for our presenters during the presentation, please use the Q&A function to submit a question. We will answer any questions that come through the Q&A at the end of the presentation. Additionally, after the webinar, you'll receive an email from me that will contain a link to complete a quick evaluation form. We ask that you take a moment to provide us with feedback so we can incorporate it into our future events. I'm now going to hand it over to Holly and Eric to begin the presentation. Thank you.
Thank you, Ashley, and thank you everyone for joining us today. So we're going to talk about and discuss tax planning for 2024 and beyond. And our goal was really to make you aware of some of the existing tax provisions and also some of the changes that are coming up and really what you should be aware of. So let's kind of jump in and look at the agenda and the topics that we're going to discuss today. So I'm going to touch on the importance of tax planning, and then I'm going to go into some of the highlights of the Secure Act. Holly's then going to jump in and talk about sunsetting tax provisions and as also some estate planning considerations that you should be thinking about. And then finally, I'm going to highlight some of the business tax updates. And then, of course, as Ashley said, we'll have Q&A at the end. All right, so the importance of tax planning. So why should we be thinking about tax planning, and really what's the importance of it? I would say the overall goal of tax planning is to minimize income tax liability. No one likes to pay income taxes, and I'm not saying that with planning that you won't pay income taxes, but how can we try and minimize those taxes? In order to do that, you really need to have an understanding of the current and potential future tax law changes, when they'll come into play, and how they might affect your tax situation. Tax planning also assists with achieving your financial goals. And finally, this is an important one, planning will also help avoid surprises. No one likes tax surprises. So let's talk about the Secure Act. The Secure Act 2.0 was signed into law on December 29th, 2022, and it included many retirement-related provisions, essentially aimed at expanding access to retirement savings programs. Prior to this, the original Secure Act, or the Secure Act 1.0, was signed into law on December 20th, 2019. The first Secure Act kind of laid out the groundwork for many of the changes, and 2.0 kind of expanded on the original. Some of the highlights included automatic enrollment of participants into new 401k and 403b plans upon becoming eligible. In the past, many employees had to opt in. Now, with these changes, they'll automatically be enrolled and may opt out within 90 days. But the thought is that, once somebody's enrolled, that they're going to kind of stay in the plan. Of course, with most provisions, there are exceptions. And one of those is small businesses with 10 or fewer employees do not have to opt into this. There were also credits that were put into effect to help small businesses put a pension plan in place. And this act enhanced those credits to further incentivize businesses to set up plans. That's one of the main goals of this. There were also changes to the required minimum distribution beginning dates. So through 2019, the first year someone had to take an RMD was at 70 and a half. In 22, that changed to age 72. Starting in 2023 through 2032, the age was changed to 73, and beyond 2032, the age will be 75. In general, there's also an increase to catch-up contributions put in place. Current contributions for someone age 50 or over is $8,000, which includes a $1,000 catch-up. This is for an IRA. The amounts are increasing as of 1/1/25 for those ages 60 to 63, and the amount's going to be up to $10,000, which includes the catch-up. Once you hit age 64 rather, the catch-up amount reverts back to the normal amounts, and of course, different rules for different types of plans. So this is really just to kind of let you know that the catch-up amounts will change. The Secure Act provisions now permit employers to offer de minimis financial incentives to try and increase employee participation in those workplace retirement plans. An example would be a low dollar amount gift card. Again, this is just to get more people to start putting money away for retirement. And now qualified part-time employees can be included in plans. Previously, these employees were excluded from plans. They still must meet certain requirements, such as 2 years of service and certain minimum hours. The Secure Act also created emergency savings accounts that can be established as part of current retirement plans that can be accessed by employees. These are capped at $2,500, and the employees can take up to 4 withdrawals per plan year without any fees or charges. This was enacted to kind of deter individuals from taking funds from their current retirement plans for emergencies. If someone does need to take an early withdrawal from a retirement account, additional exceptions to the 10% penalty were provided, such as for personal or family emergencies, for those who experience domestic abuse, for those who are terminally ill, and those affected by federally declared disasters. The Secure Act also permits penalty-free withdrawal up to $5,000 from qualified plans for qualified expenses related to the birth or adoption of a child after 2019. This limit is per individual, so a married couple could each receive the $5,000. And another item that that was not on the slides that I wanted to point out was the Secure Act provided the ability to do a tax-free rollover of the residual funds from a previously established 529 account, which is a college savings plan. This rollover can be made to a Roth IRA for the beneficiary of the 529. Of course, like everything, it's subject to limitations. This was just meant as another alternative for what to do with those funds remaining in your 529 plan, rather than taking them out as a taxable distribution just to close out the plan. So just another alternative. So with that, I'm going to turn it over to Holly to discuss sunsetting provisions.
Thank you, Eric. I'd like to talk a little bit about the Tax Cuts and Jobs Act of 2017. Back in 2017, Congress passed this act, which included major changes to the tax code. However, many of these changes were temporary and are set to expire on December 31st, 2025. While the end of 2025 may seem like a faraway time from now, with the 2024 election, we may see changes in the control of the government, which may result in a flurry of action post-election, a pause for the next Congress to take over in January 2025, or the continued gridlock we see today. Either way, taking action now is the best way to protect your assets and be ready for whichever way the law lands. So now we're going to talk about some income tax provisions. A large part of this law change revolved around income taxes. And what we'll see on the next slide is that the tax brackets, while we still have 7 tax brackets today, as we had in 2017, in most instances, the tax rates were lowered, so everyone was paying a lower amount of tax. At the end of 2025, the tax rates will revert back to the original amounts, where the highest tax bracket will be 39.6%. So those that are currently paying 37% will pay an additional 2.6% on their income tax. But you'll also see that every bracket steps up a little bit other than the 10% bracket. So what we can see here is that an average earner, married filing joint couple, will pay a lot more in taxes after these changes revert back. we're currently in a window of lower taxes. So actually, if we could please go back to the prior slide. So one of the things that we can do is look for planning opportunities. Sorry, I thought there was another slide there, but it's probably later. I apologize. We'll just go on to the next slide, Ashley. So with the reversion also is the standard deduction. The Tax Cuts and Jobs Act essentially doubled the standard deduction for taxpayers. And with that, many taxpayers no longer took the advantage of itemized deductions because their standard deduction exceeded the amount of their itemized deductions. In 2026, this will revert back to a lower amount. And the amounts you see on the slide are what we estimate as the amount is indexed for inflation annually. As to the itemized deductions, with the Tax Cuts and Jobs Act, we ended up with the state and local tax limitation of $10,000, where individuals for itemized deductions were limited to only a $10,000 deduction for income taxes, property taxes, and things of that nature. And where we live, that's a very easy number to achieve just on property taxes alone. Mortgage interest is limited to the first $750,000 of qualified debt. And qualified debt means debt that was used to purchase your home or to make major improvements to your home. There's no deduction under the current law for home equity loans unless those monies were spent for home improvements as a qualified expense. For charitable gifting, you can give up to 60% of your adjusted gross income away to charity. And most miscellaneous itemized deductions have been completely eliminated. So currently you get no benefit for things such as investment fees paid to your broker or accounting fees and employee business expenses. In 2026, we'll revert back to the original law where there'll be no limit on the state and local tax deductions. The first $1 million of mortgage qualified debt the interest will be deductible, as well as the first $100,000 of home equity loan, regardless of what the home equity loan was spent on. Charitable gifting will drop down to only 50% of your adjusted gross income, and all of those miscellaneous itemized deductions will come back into play to the extent that they exceed 2% of your adjusted gross income. With the return of the popularity of the state and local tax deduction and other itemized deductions, many taxpayers will fall back into the alternative minimum tax. Under current law, most of us have seen the alternative minimum tax become a non-existent thing. A lot of taxpayers don't even fall into the criteria for the alternative minimum tax to come into play. With the reversion back, we'll see many taxpayers coming back into this as the phase-out levels will drop back down to a lower level. As people continue to deduct large amounts of state and local income taxes, which are an add back for the alternative minimum tax calculation, they'll end up paying the alternative minimum tax. So we'll see all of this revert back to the original 2017 levels in the end of 2025. Other changes that we'll see are the child tax credit. The Tax Cuts and Jobs Act increased the qualifying child deduction or credit of $2,000 per child, while it will revert back to the original $1,000 per child in 2026. And the Tax Cuts and Jobs Act also suspended the personal exemption. So for each taxpayer, their spouse, and dependent, we used to receive a deduction on the calculation of our taxes. This was eliminated under the Tax Cuts and Jobs Act. However, the amount will come back as a deduction in 2026, but it was offset by the change in the standard deduction, which was previously basically doubled to make up for that amount. So here are some planning opportunities that you can consider now while the tax rates are still lower. Things that you can do to take advantage of the lower tax rates are Roth conversions, where you convert your current existing pre-tax IRA to a Roth IRA, and you pay the tax with your other assets and roll the whole amount over into a Roth conversion, the benefit of that is you're paying the tax at a lower tax rate today than what you might potentially pay in the future. And those Roth accounts have no required minimum distribution, so you don't have to worry about taking them out when you get to a certain age. You may have stock options that it may make sense to exercise today, as they'll create ordinary income and you might pay a lower tax today than in the future. Also, if you're planning on retiring now or in the next few years, and there may be a large deferred compensation payout, you may want to consider doing that retirement prior to the tax law increase and pay the 37% versus the 39.6%. Or if you're thinking about selling your business and there's a large ordinary income component to that transaction, you might want to consider doing it now versus when the tax rates go up. So now we're going to talk about some estate and gift tax provisions that were impacted by the Tax Cuts and Jobs Act. So under the Tax Cuts and Jobs Act, the annual amount that each person has that they can give away during lifetime or at their death, estate transfer tax free, went from 5.49 million to 11.18 million for 2018, and then it has increased annually based on inflation. For 2024, each person's lifetime exemption is 13.16 million, which means a married couple can essentially shelter $26 million of asset transfer. We estimate that in 2025, that amount will be 14 million per person. And then in 2026, if nothing changes, that's set to be dropped down to about 7 million. And that number will be calculated to an exact number based on all of the inflation adjustments off of the original number at that time. And currently, the annual exclusion, the amount that a person can give away to another person, which is not impacted by this sunset, is currently $18,000 per person. And we estimate that for 2025, it'll be $19,000 per person. So as you can see from this chart, the lifetime exemption that you're sheltering up to a 40% tax rate, depending on the amount of assets that you have as an individual. So you want to be mindful of that tax savings based on your planning opportunities. So what can you do? You have to give away more than the projected revision amount for the planning to make sense. So if you have $6 million to give away, giving it away today doesn't really do you any good, because the giving it away, you'll still have that 6 million when the amount drops back to 7 million. However, if you have 15 million to give away today and you give away some portion of it, as long as you're giving away more than the 7 million that we're projecting it to drop back to, that amount above the 7 million will be captured, and there's no retroactive clawback type thing where you would be taxed on what you gave away that was more than what the new amount is. When the revision happens, you'll have exhausted all of your lifetime exemption. So future gifts beyond the annual exclusion gifts may be taxable along with your assets held at the time of your death. So in this planning, you want to be mindful that you may be creating a future tax, but you're still saving tax today by capturing this extra exemption that's available. And then once you've exhausted your lifetime exemption, there's a lot of way to make smart gifts that don't utilize your any kind of annual exemption, or they're not subject to gift tax. If you make medical payments directly to a provider, whether that's health insurance for your family, or whether someone has, some kind of medical condition or something that requires ongoing treatment, paying those medical payments directly to the provider on that person's behalf is not considered a gift. If you make tuition payments directly to the school for a private elementary school through college and advanced degrees, all of those tuition payments paid directly to the school are not considered a gift. And then spreading your gift among individuals. If you have a child and they have a spouse and they have 3 children, you can give each of them a gift of the annual exclusion amount without triggering any kind of gift tax. So you want to maximize those annual exclusion gifts. Next slide, please. So some planning opportunities, we talked about just briefly, outright gifts to family members. You can also make gifts to what we call a spousal lifetime access trust, where you create a trust for the benefit of your spouse, and they have access to the assets in that trust for their lifetime. You could make gifts to grantor retained annuity or income trusts, and this is an opportunity to create a trust where you as the grantor benefit from the trust, as well as those that you leave the remainder to. You could consider giving your vacation home or your personal residence to what we call a qualified personal residence trust. With this type of trust, you make a gift of a small amount because you retain a period of use of the asset. You could make a gift to a charitable remainder annuity or uni trust, where you can give money either, you can give money to a charity at the end of the term period, and you can receive an annuity back either for yourself or for the benefit of another family member. You could make an installment sale to an intentionally defective grantor trust. So you could sell maybe a portion of your business or all of your business or a particular asset to a trust and take back a note. And when you're making these gifts, it's important that you use valuation discounts when you can to maximize the benefit of the gift, where you could say, because of minority ownership interest or other factors, a gift of a portion of something is worth less in total than the gift value because of the lack of control or the lack of the ability to transfer that asset to others. So some key takeaways are to always know and understand your current plan. Make sure you follow the plan steps and have properly titled your assets. You want to make sure that whatever you and your advisors have come up with as the plan that you're going to do to give your assets away, you take the follow-up steps and you actually make sure that assets are moved into the names of these new trusts, or they're moved into the names of a revocable trust. So you want to make sure that you've followed the steps of the plan and you've titled the assets properly. You want to consult with your advisors and test your plan and update your plan on a regular basis. You can't always just do a one and done type thing and put it on the shelf. You have to make sure that, if something's changed in your life, you've come into additional monies, or, one spouse becomes ill or dies and you don't have access to the assets that are in their trust. You have to rethink the plan and make sure that it still works for you and your family. Or if you have a remarriage or a new marriage, you always want to make sure that you're testing the plan and making sure the plan is up to date. And when you're making the plan, you want to make sure that it is flexible for changes in the law. You don't want to necessarily say, I want to put this amount of money into a trust. You want to make it flexible where it refers to the current tax law limits. And then make sure that you are maximizing the use of your lifetime exemption while it's still at the higher level. Back to you, Eric.
All right, thanks, Holly. So let's talk about some of the business tax updates now. I wanted to start with some of the business provisions that are also sunsetting as of 12/31/25, or maybe not in the case of the first one, at least. One thing that is not changing is the C corporation tax rate. If you recall, the rate was changed from 35% to 21% as part of the Tax Cuts and Jobs Act of 2017. This lower rate will remain in place unless it's, revised by subsequent legislation down the road. One of the items that will go away is the QBI, or the Qualified Business Income Deduction, which is a 20% deduction for certain owners of pass-through entities who meet certain qualifications. This is set to expire as of 1/1/26. And there are also changes to bonus depreciation on qualified property that many businesses have taken advantage of over the years. And as you can see here from the slide, bonus depreciation was 100% through the end of 2022. That did change to 80% for 23, 60% for this year, 2024. And as you can see going down the list, after 2026, it's going to go away. However, Section 179 property expensing, which is another form of accelerated depreciation, is still available. The maximum amount of qualified Section 179 property that can be expensed for 2024 is $1,220,000. There are, of course, limitations and caps, as I've mentioned before, but this is another potential advantage to or option other than bonus depreciation as that winds down, depending on the level of assets that you're placing in service in your business. Just to shift gears a little bit, I wanted to point out that the Employee Retention Credit, or the ERTC, has had a processing moratorium put in place as of the fall of 2023. Due to a surge in questionable claims, there was apparently a lot of fraud related and wrapped around this ERTC. The IRS still has not begun processing claims again this year, at least as of 2 weeks ago when we were following up on a particular client's claim. They advised us that they still had not begun processing those claims, and they weren't quite sure, at least as of that point, when they would. And there is talk that the ERTC is going to go away as part of future bills, one that's actually being worked on now, which I'll talk about in a minute. Let's talk about the R&D expense changes. So effective for years after 12/31/21, R&D costs now have to be capitalized and amortized over 5 years, or in the case of foreign costs, 15 years. The R&D credit can still be taken. So really, we recommend that as part of your R&D credit analysis, if this is something that affects your business, we recommend that you have an overall expense analysis be completed based on guidance that was released by the IRS. There could be some costs that are taken into account for the credit that are not, for purposes of overall R&D expenses. So it's something that you want to be aware of. When this went into effect, it was a major hit for businesses because, for many, you're talking about a huge amount of cost that you now have to spread out over a number of years rather than expensing all in 1 year. What I will say is that as of January 16th, 2024, a bipartisan bill was introduced that would temporarily restore R&D expensing rather than capitalization. And this would be retroactive to 2022, and it would be through 12/31/25. This bill also talks about restoring 100% bonus depreciation for that same time period. I did go online before this webinar to kind of see where things were going, and it was reported that the House is supposed to put this bill up to full vote sometime today between 4 and 8 o'clock. But there is a lot of infighting going on, and even if it passes the House, it's then got to go to the Senate, and there's already talk that they want to make changes. So who knows what's going to happen? But it's being talked about more now than it has been over the past year. So maybe there's some hope for this. So let's talk about net operating losses. Post 2020, net operating losses are carried forward indefinitely, but they're now subject to 80% of taxable income limitation. Prior to 2020, these NOLs were allowed at 100%, but they could only be carried back 2 years and forward 20. Now they're not able to be carried back at all, and they're carried forward indefinitely. Just a quick note on meals and entertainment expenses. You may recall that during the pandemic, certain meals were 100% deductible in 21 and 22. This was kind of to help spur people either ordering takeout or going out to certain restaurants, when that was, allowed. These expenses revert back to 50% deductible in 2023 and beyond. And also a note on entertainment expenses. These also used to be deductible for 50% before 2018, and the Tax Cuts and Jobs Act made those non-deductible beginning in 2018, and there's still no change to that moving forward. And finally, I wanted to point out the pass-through state income tax deduction. As of 2023, 36 states have some form of this pass-through deduction, which was essentially put in place to help combat the $10,000 cap on itemized deductions that was put in place on individual returns. For New Jersey, it's known as New Jersey BATE, or the Business Alternative Income Tax. It essentially allows pass-through entity to elect to pay the state income tax due on the business income that would otherwise pass through and get paid on the owner's personal returns. The payment would be a deduction against the owner's federal income. Most states, as I've read, do have a provision in place that if the SALT cap that Holly mentioned sunsets, that this PTE or pass-through entity state income tax deduction could go away, but that would be kind of on a state-by-state basis. So with that, Ashley, I will send it back to you to see if there's any questions.
Okay, thank you, Eric. We do have two questions. The first one is for Holly. Is the $18,000 cap for gift per gift giver or gift receiver? For example, can an 18K person?
So Ashley, that's a great question from our guests. It's per person, per giver, per recipient. So a husband and wife could give one child each $18,000, so that one child could receive $36,000 from their parents. What we see a lot of times is the question then becomes, how did we give that gift? If dad has the checking account just in his name and he writes a check for $36,000, that's okay, as long as we file a gift tax return so that the mom and the dad can elect to split the gift. If both mom and dad have a checking account and they each write a check for $18,000 to the child, that's great too. And then we don't need to file that gift tax return because the gift came from mom and from dad. And so if you need to make a large gift to a family member, you know, you can split it between both parents. And if that family member has a spouse or children, you can make the gift to each of them as well, so that you can kind of trickle down the gift and give a larger amount.
Okay, thank you. Eric, a question for you. Regarding R&D, since Congress is showing some life to possibly make this more favorable, will Mercadien be advising clients to hold off filing to see how Congress plays out in the coming months, similar to last year?
So absolutely, I will be recommending to my clients that since there is some real life to this, you know, unless it takes a turn for the worst, which is possible, that, you know, returns are extended. Hopefully we have some sort of resolution before pass-through entity returns are due, which is 3/15, and C Corp returns 4/15. Hopefully we know more as far as where this is going. But even if this is passed and it's favorable to clients, we're still going to have to wait for guidance to come out as far as, you know, whether 22 needs to be amended, or are they going to make some sort of provision to make adjustments for that on the 23 return? We just don't know. So we're going to have to wait and see if this happens, which would be great news for our clients, at least through tax year 2025. And if it is, how will we, you know, what's the best way to handle everything?
Okay, thank you. So I believe those are all of the questions that we have for today. I want to thank Holly and Eric for a great presentation. And thank you all for joining us today. We hope to see you at our next event. Thank you.